Welcome to Indianomics. Has the Capex cycle picked up? That's the question we are asking today. Let us start with some data, investment as a percentage of GDP. Now, as you will see, this has recovered from the COVID lows of 25%, but it has not reached anywhere near the pre-COVID level of over 30% of GDP. So let us look at something that we all believe is doing well, government Capex, especially central government Capex. Now, central government Capex as a percentage of total investment has clearly gone up. But it is only replacing what has gone down in terms of state government Capex, which has done badly in the last FY23. But, central and state governments together barely account for just about 12-13% of the total investment. And as a percentage of GDP, it's just barely 4%. So we have to depend on the corporate sector. It is the corporate sector that accounts for about half the investments in India. So how have corporate investments done? As you can see, as a percentage of GDP, if you look at it, it has fallen very sharply from about 25% in FY02. In the years 2012 to 16, it's about 17%. In the years 2017 to 19, it's about 15%. And 21, it's fallen in COVID years. And even now, it's barely reached 14% of GDP. A last bit of data, did the foreign investment make up to fill the gap? Latest data shows otherwise. Gross FDI flows look good in 21 and 22 because of all the startup mania, but it has not even grown at the pace of nominal GDP of India. Net FDI, on the other hand, has actually fallen in the past few years despite PLI schemes and the China +1 hopes. So, what is the experience on the ground? Are these macros really telling the full story? We are joined by Mr. R Shankar Raman, the whole-time director and CFO at L&T, Nikhil Gupta, chief economist, Motilal Oswal Financial Services, and Hetal Gandhi, director at CRISIL. Gentlemen and Hetal, thank you very much for joining. Mr. Shankar Raman, the economists have kind of had their say. I took some of their data from actually Nikhil's report. You tell us the situation on the ground. I'm not asking you for perspective, but as of the last 1 or 2 years, has Capex picked up?
I think, Lata, you are very right that the COVID year really saw the Capex plummet because people wouldn't know where business is headed. But I do see over the last 2 years, and if I'm using our businesses as a prism for assessing the recovery of Capex, so to that extent could be limited to the areas that we participate in. But nevertheless, I think there has been a pickup that I see. But the pickup is very sector specific. It's not across the board. There are some sectors which have had an early start. I think the commodity inflation, the pricing power that the minerals, metal sectors enjoyed ensured that they increased their capacity to go to market quickly when the price advantages were existent. So the steel companies expanded their capacities, the aluminum, the copper, those expanded the capacities. But what I find is that the increase in the capacities have been in sectors where the economic returns out of the invested capital looks a little more assured. Okay. Automobile, for example, there's been a pickup in automobile sector. Okay. And with EV coming in, I think there's been expansion of lines, either specific to EV or generally expanding the capacity. Okay. So those investments we are beginning to see. On the back of construction doing well, the construction products, maybe cement, maybe some of the paints, fasteners, those are increasing their capacity. Based on the data, digital growth, the data growth in India, the data centers are getting invested in. So you find that in select sectors where there is economic compulsion, investments are coming through. Okay. Most of the corporate balance sheets are cleaned up. The banks are quite healthy in terms of their ability to lend. So the environment is good. What is important is predictability of returns. Yeah. You also showed data from 2008, and I just want to draw attention of the panel and the viewers to the fact that the high Capex from private sector was on the back of large-scale participation in building public assets. The PPP mode that was rolled out initially received a lot of, attracted a lot of private capital. But then people realized as they went along that private-public partnership is not an easy
Yes.
bus to ride on. And there are several challenges along the way.
Yep.
And the private capital does get stressed because of several, partnership-related issues and policy-related constraints.
Yep.
So I think the dip in private sector capex between 2011-12 to 2018-19 can also be traced to the shrinkage of private capital in infrastructure assets.
Oh, absolutely. I mean, land acquisition was a nightmare, and even charging for toll roads or for power was a political hot potato. So a lot of investments got stranded. But now let me get to the economists. Hetal, in your study, you are looking at sector specific. So where do you see capex growth? First of all, the overall question. Do you see capex growth already? I'm not asking you for prospects.
Yes, so we are seeing capital expenditure growth already. I think the first half numbers where companies came up with abridged balance sheets also indicated that there is a growth that's happening. First half, around 350 odd companies which we studied showed almost a 23% increase in capital expenditure. But I totally agree with Mr. Raman where, it is patchy. It is not spread across. You have commodity sectors that are contributing to almost 55 to 60% of the capex that has happened in FY23. And that tells you the story. We have new age sectors which is coming up, which is a trend that is picking up. So, for example, capital expenditure that is happening in oil and gas, you are seeing capex that is happening in new age areas like green hydrogen. You are also seeing announcements which are happening in the space of electric vehicles and linked ecosystem. So we do believe that combination of some recovery on the commodities side and investments on the new age side combined together is driving the growth in capital expenditure that we are seeing as of now.
Okay. Driving as of now. But Nikhil, your numbers were giving us only one impression, that as a percentage of GDP, neither corporate investments nor overall investments have matched up to the pre-COVID level. Can you elaborate on this, or, you can even disagree with it?
Hi, thank you, Lata. Yes, so this is very clear, Lata. Two things. One, if we look at the growth, no doubt FY22 and the first 9 months of FY23 for which we have data, and we have FY23 full data for some indicators, growth-wise, it is very good. We have seen 20% plus growth in some of the areas as well. But what eventually matters, I guess, is investment, be it corporate or total, as percentage of GDP, because there is a massive base effect. FY20, FY21, we all know because of COVID, there was a decline in most of the indicators. There is pent-up demand that has been there in the system for the last 2 years. And all that has led to much better growth. But when we look at investment as percentage of GDP, which we call investment rate across all countries, there, as you have already shown, it was much lower than where we were in the years prior to COVID-19. Okay. Now, if you look at full year FY23, it is possible that the number may be close to 29, 29.5, which will still be close to the worst that we saw prior to COVID-19. This is on gross fixed capital formation. When we talk about the key components, for example, you showed about government. The central government has done immensely good job. There is no doubt their capital expenditure has more than doubled in the last 3 years, including the COVID years. So they have done superb job. But when we talk about the economy, what eventually matters is central government plus state governments plus PSU. As you showed, there has been a decline in state capex. But if we include central PSUs as well, you will see that most of the increase in the central government capex has happened at the cost of CPSEs, which is good again because probably had the central government not taken over that capex, CPSEs may not have done it anyway. So central government now, since they have taken it on their books, it is happening. But it is when we look at the aggregate public sector capex, we published a note wherein we showed that public sector capex, by which I mean center plus state plus CPSE,
Yes.
their capex as percentage of GDP was less than 6% in FY23, which was the lowest in 8 years.
Okay.
The lowest in 8 years.
Okay.
So again, there is some reallocation happening. There are pockets which are doing very well, but if you look at aggregate growth, it is also very good. But as percentage of GDP, government or the public sector capex, which I believe is a much appropriate way to look at it, it was the lowest in 8 years, and overall GFCF as percentage of GDP is still weaker. Until and unless I think we reach 31 or 30% fixed capital formation, I don't think we can call it very strong.
Yes. I have also reported during the 2000 to 2010 period when we also went over 34% in a couple of years, investment as a percentage of GDP. And another number, I didn't want to clutter with more numbers. States actually account for 2/3 of Capex. If you take historically, the last 75 years, state government Capex is 2/3 and central government Capex is 1/3. So even if you replace, the central government doesn't entirely replace if states are not investing. Mr. Shankar Raman, let me get some idea of how the future is looking, because the orders first hit a company like yours. Are you getting a sense that we are headed to do better? Because if I look at your order book, it's stunning. Probably some of it, of course, is inflation, but it's a stunning growth from about 2.6 lakh crore in FY19 to nearly 4 lakh crore in the last quarter you reported.
Yeah, I think a couple of things play out to this, Lata. One is the infrastructure thrust has been a large reason why the order book has been the growing way it has been growing. And secondly, Middle East, which is the market outside of India that our company is involved in, is also doing very well on the back of firm oil prices. A couple of trends are happening here. One is, I think there is a big realization that there has to be life beyond exporting oil in the Middle Eastern countries. They're investing in downstream products. They're investing in broadcasting their infrastructure. And also there is a big energy transition that is sweeping through Middle East as well. So the investments that is happening there and our own presence in those markets have been very productive for us in terms of accruing international order inflow. Okay. But on the context of private sector capex, I think the last 2 years India has seen an uptick also. We ourselves, just as a data point, in FY22 we had private sector orders at about 26% of the incremental order intake for the year. And that moved to 32% in the year FY23. Okay. And according to me, that is a sharp increase. And if I slice it as what is that the private sector contributed, we had close to 2,30,000 crores worth of fresh orders in FY23. And the private sector capex out of that was almost 55,000 crores. And this was 40,000 crores a year ago. Okay. So I think some of the sectors where the investments are coming, as I had mentioned earlier, the commodity related sectors, the automobile related sectors, the construction equipment sector, hospitals, and energy transition. I think a lot of investments are happening either in adopting greener fuel or reducing the emissions of the current industries. What we have not yet seen, and I think that is still waiting to happen, is the large scale associated investments around the mobility. Meaning the freight corridors will have to have a lot of investments around loading, unloading points and transshipment points. And the station development program that the government has thought of. It's also another large area where private sector is expected to participate. Now, these are events that are not yet happened. And the large investments announced for the semiconductor industry, the electronics industry, etc., they've not hit the ground yet.
Yes.
So if I look at it from that possibility, it looks to me that another 15 to 20% growth in private sector capex is possible in the next 12 to 18 months. So I'm very hopeful.
Okay, let me stop you on that optimistic note because we have to take a break. We're going to come back and ask the bigger question as to whether the K-shaped recovery is putting a demand control on many industries into their capex plans because there isn't enough demand. So there are such other questions. The Bazaar viewership will get to see Chartbusters, but this entire show will play later on after market hours. Back in a jiffy.